Good evening, everyone. Can you hear me all right? Good? All right. Well, my name is Peter Levy, and I am a shareholder at the law firm of Mandelbaum Barrett. It is my real pleasure to welcome you all here tonight. We have done this seminar on a number of occasions. I will tell you, it is my favorite event of the year. We've had Bill Barrett, Mark Murphy, Steve Goldberg for a number of years as our esteemed panelists. You're going to learn a lot, and there's a lot of information they can share. What makes this really special, though, is that you in the audience, we like to make this interactive, so please feel free to ask questions. We encourage you to ask questions, and it's a wonderful opportunity for us to share and learn together. In addition to our three panelists, I'm also going to introduce you to Mr. Nicolai and Mr. McGrath, who are two business owners who will share their personal and professional journeys with you regarding how they've gotten their business to the next stage of its own business cycle. So the calendar tells us that today is May 10th. And that means we've got Mother's Day 3-4 days from now. So first thing, I want to wish all the mothers in the room a very happy and prosperous and healthy Mother's Day. But I always felt Mother's Day was an easy holiday. With your moms, you buy flowers, maybe chocolate, take your mom to brunch, very, very easy holiday. Father's Day, I always thought was more challenging, both as a giver and as a recipient. Just by a show of hands, would anybody agree with me that, at least the fathers here, anybody get some very strange gifts on Father's Day here? It's, I got some of the strangest things you've ever seen over the years. But last Father's Day, my daughter gave me a gift, best gift I've ever received. And it's from a company called historicmail.com. And every week, I either get a letter, it's a replica, an actual replica of a famous historic letter or an artifact. So today being May 10th, on May 10th, 1940, Winston Churchill, arguably the greatest leader of the 20th century, was elected Prime Minister of England for the first time. And in his first speech, perhaps his most famous speech during his Prime Minister role, he spoke to the House of Commons in Parliament. And so May 10th, 1940, in his speech, he said, "I have nothing to offer but blood, toil, tears, and sweat. Think about yourselves as business owners. Think about the blood, the toil, the tears, and the sweat all of you have put in to get your business to the stage it's in now. With that in mind, take this opportunity, and when you hear what's being discussed by the panelists and think about where you're taking your business in the next stage, I think all of these men can help you get the most out of your own blood, toil, tears, and sweat." I'll begin at my far right. At the end, we have Mr. Mark Murphy. Mark is a transformative CEO, an author, a speaker, a motivator, and he leads the Northeast Private Client Group in innovative financial planning and wealth management. Mark empowers entrepreneurs to achieve multi-generational wealth through personalized strategies and expert financial engineering. In fact, Forbes has named Mark as the #1 financial securities professional in the state of New Jersey and number 15 nationwide. Mark's best-selling book, which I have in my hand here, and he has taken the time to graciously autograph a copy as a gift for all of you here. Please make sure that you get a copy in the back of the room after the presentation. And it's a special gift from Mark. It is a best-selling book. It is entitled The Ultimate Investment. Mark is also the host of a highly ranked podcast called the Hero of the Hour. All of these things demonstrate Mark's dedication to excellence in the industry, and you're going to learn a lot from this very smart man. Next to Mark is Mr. Stephen Goldberg. Stephen Goldberg is the managing partner of Sun Mergers and Acquisitions, as well as Sun Business Valuations. Stephen brings over 30 years of M&A and business valuation experience to the helm of both entities. Sun M&A specializes in sell-side advisory services, and Stephen has assisted over 300 entrepreneurial mid-sized companies. He handles all aspects of the sale of their companies. Sun Business Valuations provides certified business valuation services, having handled thousands of business valuation engagements for business sale consideration, shareholder buyouts and agreements, estate planning, divorce, and a variety of other purposes. Stephen's involvement in all aspects of closely held company sales provides insight for anyone who is considering a business sale or an option regarding the sale of their business. And Stephen is a true expert in understanding the valuation of any company. Stephen's companies, Sun Valuation and Sun M&A, also have a table in the back, and please get some information on his companies when you can. Next to Stephen is Mr. Richard Nicolai. Richard is one of our guests here, having made the journey as a business owner. Richard acquired a company from bankruptcy over 20 years ago, and he rebranded the company Apogee Lighting, which now has become the leading manufacturer of specialty transit, industrial, and architectural lighting in the United States. His company has earned a reputation for delivering innovative lighting solutions and transit systems throughout the country. If you have taken a subway ride in New York City, you have seen Apogee's lighting fixtures. Richard sold his company to a private equity firm a few years back while reinvesting and keeping a minority position in the firm. After a transition period in which a new CEO was hired, Richard now serves in a board of director capacity. And thankfully, I assume he has the opportunity now to pursue many other personal interests. Next to Richard is Mr. Paul McGrath. Paul has worked at City Fire Equipment Company since 1981, and he has been the company's president since 1994. Paul has worn many hats while at City Fire. He started out as a fire extinguisher technician, coming all the way to his current role as president. Paul has helped City Fire grow to become one of the most recognized fire protection companies in the state of New Jersey. And education has always been a huge part of Paul's impact on the fire community. Along with running City Fire as president, they present a publication called Fire Facts to the fire community. And Paul is currently a member of the board of directors of the New Jersey Apartment Association. He is also the immediate past president of the New Jersey Society of Fire Protection Engineers. And Paul is a New Jersey State Fire Commissioner. Finally, last but not least, my dear friend and my partner and the CEO of our company is Mr. Bill Barrett. Bill Barrett is known across the country as a deal maker and a key business strategist. As the CEO of Mandelbaum Barrett, he has taken the full-service law firm to another level. Bill has over 25 years of experience serving as outside corporate counsel to all kinds of businesses, and Bill specializes in mergers and acquisitions. Bill has successfully managed the purchase and sale of hundreds of businesses. Bill has also written 2 books on various transactions within the dental industry. I believe you can get copies of those books in the back as well. And Bill is currently working on a 3rd book. The 3rd book is geared towards personal growth for entrepreneurial-minded business owners. I have had the pleasure of seeing Bill's leadership from the inside, and he is transforming the practice of law. So I'm going to turn the program over to our panelists. Particularly, I'm going to ask both Paul and Richard to kick us off by telling us briefly about their own business journeys. But before I do so, since this is my Winston Churchill night, I'll leave you with one other Winston Churchill quote, because I think it's particularly significant and telling for business owners. And this is my favorite Churchill quote. "Success is not final. Failure is not fatal. It is the courage to continue that counts." So with that in mind, let me ask Paul and Richard to please share your stories, and I welcome everyone here.
Thanks, Peter.
Okay, well, I'm happy to be here. I'm delighted that I was asked to tell my story because I don't really get an opportunity to tell people this. But so we bought our company over 20 years ago, and it was in bankruptcy.
Talk a little louder.
I don't know what.
Is the mic
You
on?
gotta talk louder. You just gotta talk louder.
Okay,
Just talk louder.
I'll give it a try. How's that? Any better? Okay.
We're soft speakers.
So we bought the company out of bankruptcy. The good news about that is there's only one way to go, and that's up. So I kind of did a little research to find out why did the company fail before we got it, and it had failed actually twice with two owners prior to it. So I found out what they were doing wrong, and we made the corrections that we needed to do. I rolled my sleeves up, worked hard, and I could tell you that within a year and a half we were profitable. So my primary customer was the New York City Transit Authority, the MTA, the very demanding customer. And that's why a lot of guys failed with this company, because they're very demanding and they just couldn't step up and meet their expectations. We did. But when we did that and we met their expectations, it paid off big time because they just threw more and more work at us. So my company grew. But at that point, we were doing a good piece of business, but we were a one-trick pony. Our only customer was the New York City Transit Authority. And I've learned by talking to other owners and people who bought and sold companies that buyers are not going to buy a company with one customer. So I started to expand. So we started to go into different markets. So we got into Boston, and then Washington, D.C., then Los Angeles, and other cities. But we started to do more business. So when I got to that point, I had something to offer. And that's what we did. And with Stephen's help, Stephen represented me in the sale. And when I put the company out for sale, we had a lot of people who were interested because we were very profitable. We had a tremendous backlog, and we had an organization in place. That's another thing that I learned from other people in the business, that they said you have to have an organization. For a long time, I was like the only guy. I was number one. I wore all the hats. I ran around. I did everything. And while I was making money, I wasn't really growing the way I should have grown. So once I got that job done, we started to really grow. We tripled our business in 5 years. We tripled our business. Yeah, we went from a company that was doing $6-7 million a year to $20 million in about a 5-year period. So that's it, and I was happy to sell it. The people who bought it, the people were happy to buy it. I kept a piece of the company. They're still going strong. They're doing fine, and I'm happy. I'm a happy dude. Yeah. Yes. It's nothing like working your ass off for 20 years and then getting that big payday. So that was what my goal was, and I was fortunate enough to achieve it. So that's basically the story.
Okay, my mic on?
You're up.
Okay. We're soft talkers. People who run businesses have to keep it down because they want people to move. I'm in a family business. Over 40 years ago, I met my wife, got engaged, and quit my job, and her father became concerned. So he said, I said, I'm not sure what I want to do with the rest of my life. And he said, well, while you're deciding, you want to drive a truck for me. And I said, okay, help me pay the rent. So I did that. And it was like a kid in a candy store because I came into a small family business that needed a lot. And I had no experience in business. My background was science, but the mathematics of it fit very neatly into a business. And I applied what I knew to that and very quickly moved up and got involved with managing the business day to day. But in the reality, and we grew and it was exciting. It was ups and downs. It wasn't like this. It was, like this. And the big challenge and the way I spent 20 of those 40 years was managing the family. Because if the family didn't always act in their personal self-interest. And a lot of times I was spending time just helping them along and then helping certain people, certain family members exit the business and helping them think it was their idea. And as I did that, I kept elevating when I got rid of, when I helped exit one owner, I became vice president. And when I helped the first generation person realize that they should leave, I became president of the company. And as each time it was addition by subtraction. So the company would burst after that event because it was a relief and it was effort. The efforts were rewarded more. Until around 1999 when it was the last family member that was a blockade and I helped that happen. And since then I've been managing the business. And that's been the exciting part to me. And it took a little while to get it going, but by 2010 we were moving and we've been growing at a 10% or more every year after that. And in a service business, that's hard to do because you're not making big sales, you're making a lot of little sales. But you're retaining the customers and that grows the base. So as president of the company, as we grew, I was able to build a system, a structure, like Mike said, or Richard said, so that people had primary responsibilities and I could turn my head and not think something's going to fall apart. And I could work on growing the business and planning. And planning became a big part of my job in the last 20 years. And part of planning was teaching the owners who, this is a family business, started 70 years ago by my wife's grandfather. He was a Newark firefighter and this was a side job. Then his sons got involved with it, and one of them was my father-in-law in the early 60s. And then the third generation came in the early 80s, which included me by proxy. And so in 2000, when we exited the third generation person, the other three third generation became owners. So they were gifted down to that. And my wife was one of those people, fortunately. And what I did was 360 days a year, I was their boss. And 4 days a year, they were my boss. 4 days a year, I would call a shareholders meeting and report to them as the president of a company and tell them where we're at and ask permission to do what I think we could do the next year. I would get agreement and we go forward. And that model worked for us. They cooperated most of the time, which was good. But that was the model that helped me get where I am. And in my role as president, I not only worried about profit for each year, which wasn't always there in the first 20 years, but I looked at the enterprise value because this was pretty much their primary asset, the three shareholders. So I wanted to build a company so it increased in value. And I started studying that and seeing in my industry what increased the value of the business. And I learned that, and I learned what aspects were better and which ones weren't as good at that. And we went along that way. And then about 10 years ago, I started to explore what the enterprise value was, which, as you all know, is hard to figure out, especially in a service business, because you don't know what somebody's willing to pay. There's certain parameters that drive up price and certain that don't. Size always helps. And so I did that theoretically the first time around 2012, came up with an approximate value. And then in 2017, I actually took the company to market, but primarily to discover the enterprise value for the shareholders. And I got some numbers, and they were attractive, but not enough for them to leave at the age they were at. And we went along that way. And then about 10 years ago, I started to explore what the enterprise value was, which, as you all know, is hard to figure out, especially in a service business, because you don't know what somebody's willing to pay. There's certain parameters that drive up price and certain that don't. Size always helps. And so I did that theoretically the first time around 2012, came up with an approximate value. And then in 2017, I actually took the company to market, but primarily to discover the enterprise value for the shareholders. And I got some numbers, and they were attractive, but not enough for them to leave at the age they were at. And then I went through that cycle again last year at their instructions from one of those shareholder meetings. And again, it wasn't to sell the business, it was to find out what the business was worth. And to my surprise, and from what I learned from doing it before, I knew who to ask. People like Bill helped me a lot by framing the questions and understanding what to ask. I found the people in our market that wanted businesses like us and interviewed them. I didn't involve the shareholders in any part of the conversation until an offer was on the table. And that I started last March, and I got offers by August, and that's when I allowed the shareholders to interview the people. And then they all basically came to the same price because they were offered it. If they could match, we would consider them. And then the shareholders voted after they interviewed them all, and they picked them all in the same order, which was ironic. And we ended up going back to the company that they chose. They agreed to our terms, which included doing a stock deal and not an asset deal, which had an impact on our what we netted out of it. And we closed. We did the letter of intent in August, and we closed in September. We were told it would take 60 to 75 days. It took 120. Partly because of the overzealous accounting firms that they use for due diligence. And I call this my 15 pounds of due diligence. And we closed, and things went very well. You know, I was prepared for due diligence because I had education from Bill's people. They gave me a punch list because they've been on both sides of deals. So they gave me a punch list of what they would be doing if they were a buyer. So I knew what to expect. And I knew that they would ask things over and over again, which they do. But it wasn't onerous in my mind because I was prepared. And we closed on December 19th. And we've been there 4.5, 5 months. Yeah. And I'm very happy with it. Myself and one of my brother-in-laws continue to work there and in leadership roles, and we're happy with where it's going. And we also bought back into the deal. It was offered, it wasn't required, but it was offered, and we were excited about it because we're really excited about our business. But we knew we took it as far as we could financially take it. And we were getting older, so it turned out to be a good time to make the move. But the point was, when they made the offer was so attractive that it wasn't a question of whether we were going to buy it, it was a question of who we were selling to. Because the numbers from 2017 to 2022 had virtually doubled because of and that's luck. We picked the right ancestors who picked the right business to get in. Okay, I'm not, believe me, that has more to do with it than anything, because we have relatives who were very successful, had 6 record stores back in the 70s. It was a very successful business that was dissolved by technology. And it wasn't because he wasn't a good businessman, it just technology took his business away. So we were fortunate that ours was heavily labor, so you couldn't give that away yet. So I don't want to go too long, sorry.
Thank you very much.
That's great. Thank you.
All I know is if I gain nothing else from tonight, I can now explain to my wife my 30 pounds of due diligence. So
You've been working hard, Peter.
it's a good thing. And again, I've got a mic, I can travel. As you're thinking here, I hope you're all thinking of questions you'd like to ask this esteemed panel. But in the meanwhile, to kick it off, I'm going to ask Mark and Steve and Bill to give some insights into what kind of strategies are necessary to prepare your company for sale. And what do you need to do to think about increasing the value of your company?
Thank you very much, Peter, and good to be here. In terms of preparing your company for sale, it is important to be prepared, both preparation of the company and preparation of yourself as an individual and your goals. But in my opinion, the first thing is the decision. It's important to be very confident about the decision you're making. And in order to really be confident about the decision, the more informed you can be, the better. And so I think it's very important to understand the realistic valuation of the company. And I say that, look, there's a lot of business owners many times, they're like parents who have kids who play sports, and the parent always thinks that their kid's going to be in the NBA and they're going to be, or they should be getting all the playing time. And sometimes people have unrealistic expectations as far as value. And the worst thing you want to do is really go to market with an unrealistic expectation, because you jeopardize confidentiality, you take your eye off the ball. And so understanding the realistic value of the company, having a business valuation done is very, very important. We do a lot of business valuation for business sale consideration purposes. Because it's important to know, the first thing any acquirer is going to ask you is, what are your expectations as far as valuation? And then they'll ask you why. Why do you feel it's worth that? Additionally, it's important to talk to your accountant about tax implications, because it's also important to know what you're going to keep. And I'm sure Mark's going to talk about really understanding, hey, how does that fit into your lifestyle goals, going forward. Financials are very, very important. It's important that they're well organized and they're buttoned up, because as Paul said, due diligence is a bear. In due diligence now, you have these quality of earnings, and it's very intense on a business. So really being able to make sure that the numbers are going to survive the scrutiny of due diligence is important. And also what's important, with a closely held company, financials are prepared more for tax purposes, not for business transaction or valuation purposes. So you need to really make sure you capture all the add backs, the one-time or non-recurring expenses, the perks, the fringe benefits, and the various other potential add backs, so you're properly presenting the financials to maximize value. You need to be able to also talk about fluctuations. What's happening? Why is gross margin increasing? Why is gross margin decreasing? Why have sales increased? It's important to be able to tell a story behind the numbers. A couple of other things. Try to address potential deal killers early on, such as if there's any kind of environmental issues, if you're in a manufacturing business, if there's any contracts that need to be fine-tuned, if there's any kind of dependency factors that a business is dependent on, has to be addressed, like Rich mentioned. Very important to do that. You want to be prepared to respond to questions that you're always going to get. Why are you selling the company? Why has the company been doing this? Why who can the company run without you? And be also prepared to talk about growth strategies. Things that either you started doing or you would do if you had more capital, or if you wanted to grow, because people want to know where they could take it from here. But in any event, what you don't want to do is lose sight of current performance. Current performance is key, because if all of a sudden your numbers are down 15, 20% in the current year, buyers don't want to hear about how the company's grown every year for 6 or 7 years. The focus is going to be on that.
I was going to just say, I thought that was great. I think having done this for so long, I think it's as much a psychological sale as it is a financial sale, meaning that selling your business is not the finish line, it's a milestone. And I think one of the things we've done is try to put together a 12-point checklist of all the things. In fact, Steve covered a half a dozen of them, but a 12-point checklist whether you should be looking for a transition or an exit strategy. And the best ones I've seen are ones that are not sort of on a spur of the moment, but sales that have been done for and planned for years, many, many years in advance to maximize the value of the sale. The other thing I also see, besides the psychological piece that comes back, is sometimes you see a very, very big number. They give you a tremendous amount of money for your business. But I think the other thing you've got to take a look at is, after you pay the debt, if there's any debt, after you pay the taxes and the transaction costs and maybe pay some minority partners, is there enough money left to help replicate your income? Ultimately, there's dozens and dozens of asset classes. But for our purposes of this discussion, there's only 2 asset classes. And we call them either paychecks or either free capital or playchecks. And so if your business is your primary source of income, what you need to be doing while you still own the business, and then certainly after sale, is to develop a series of assets that will give you either a guaranteed or a highly reliable stream of income to replace your income in your business. I'll call those paychecks. But then you want to have another series of assets where you can spend it, you can save it, you can give it away. But the important thing is that will not be responsible for producing income for your business. And then there's still one more level. Oftentimes, if you can maintain a piece or some operating company, it allows you to very tax efficiently continue to live out of your corporate checkbook. You know, a lot of people think, oh, I can replace my income, but they forget how much they're living out of the corporate checkbook. And so oftentimes you get a lot of buyer's remorse for two reasons, I find. One is because even though they sold that business, the top line number was huge, they don't have enough money to replicate that lifestyle. And the second reason is the psychological piece where, you know, I can't tell you that, you know, we have a home in Palm Beach in the winter, and so I have a lot of my most miserable clients there. I'd say richest and most miserable clients there. And the reason they're rich is they've sold their business. The reason they're miserable is because they would say, you know, I used to have 6,000 people reporting to me, and now I go to the dry cleaners and, you know, go play golf or, you know, make restaurant reservations. And so they're you know, even with all the money in the world, they're miserable. And so I think those are the two things that I see most frequently, Bill.
Yeah, I think I'll just add on, Paul touched on it, and you know, to really say, you know, give him some credit where credit's due. He's an incredibly organized person and very methodical in how he deliberates. So when, you know, he came to us early to talk about the possibilities. I mean, even the first time around in 2017, we started the conversation. So I think early conversations with your professionals is critical. The concept that I always try to get clients to do, and of course Paul asked for it right away, and we did it, which was we took a buy-side checklist, a due diligence checklist of what is the buyer going to ask of me, and you know, which is about like 16 pages long, and most people who have been building a business throughout their career are not used to going through a process to sell a business, and that is a very eye-opening experience. And we also looked at, you know, there's a section in every purchase and sale agreement that is, excuse me, representations and warranties. Like, you know, in essence, the promises, the things that you're going to say to a buyer are true and correct. And we also kind of redacted that out and gave that to Paul so he could see, you know, okay, when you get to this stage eventually, you're going to be signing a contract that's making you commit that all these different representations are true. Things like, you know, I'm compliant in all ways with employment laws, and you know, all taxes are paid, and there's no audits pending, and you have to disclose key vendors, key clients, any client concentrations that you have, any pending or threatened lawsuits. You know, you go through and say, wow, I have to be able to represent that all of these things are true and correct and there's no issues out there. And that section of the agreement is like 18 pages long, just that one section. So to me, that methodical preparation before you sell a, you know, it starts, like Stephen said, with, you know, how do you go into a negotiation if you don't know your value? You know, I see that all the time, but on my side of the ledger, it's how do you go into a transaction not knowing what to expect? Because it can be an exhausting and daunting process if it's something that you haven't done before. Even clients who have done some acquisitions before, if they didn't do a large acquisition and they maybe bought some small businesses along the way, going into a major transaction or a transaction backed by private equity where there's a lot of sophisticated players involved, you know, is really a completely different animal. So I think that the preparation side is key.
You have any questions? Somebody want to get us started here with a question?
I would just make one comment. What Paul said is that he talked about the accounting firm grinding him down. I think that's the number one mistake, is mentally not checking out until the check clears. Because quite frankly, if you're the buyer, you want to grind you down and keep grinding you down until, and once you've mentally checked out of the business, then you're willing to take that discount. And so I think that, you know, that I think is one of the biggest mistakes where you see valuation slip away, is because, you know, that Paul, you know, I don't know anything about the specifics of your transaction, but if I was advising you, we would have been prepared to walk away if it didn't hit the threshold and the number that we wanted. And the other thing I also would say, Bill, would be that, you know, I think people, the other thing, two things when you've got time to plan, I'd not only be looking at trying to lock in the top talent, because I think that that buyer will pay more when you've locked in top talent, which helps the sale and the value of the business. But the other thing I would also do is, everybody should be doing proper estate planning and tax planning and the like. But I think what's often overlooked is asset protection planning, not only protecting this great sum of money from lawsuit and creditors, but also potentially, if you have the right circumstances, be able to shift that business to a state where you may not pay state income tax on that.
We have a question here.
Yeah, Paul, your comment about having it be a stock sale versus an asset sale really perked my ears up, just thinking about the difference between the tax ramifications of a long-term sale at 21% versus however else it would fall apart.
It's about 5% difference between a stock and a asset sale. In my business, where there's a lot of liability, because anytime there's a fire in a building that we have equipment in, we get sued. So there's always a liability out there. So it's hard to get a stock sale in our industry. But we were able to leverage it because we had multiple offers. So that made our net significantly higher by 5%, which when you look at the cut that the state and the federal government gets, 5% is a lot of money.
So I don't know who to direct it to as far as sales. Is that a difficult threshold to try and transition a buyer into looking at an asset sale versus a stock? Or?
I think the benefit is to have multiple buyers, so you have leverage.
One other question, Mark, you mentioned about retaining key employees. Are there certain special tricks, things that you could recommend?
Yeah, there's 4 or 5 ways you can do that. Everything from, actually selling them a tiny piece of the business to, employment contracts to deferred compensation agreements. There's a plethora of combinations and permutations. But, ultimately, I think if I'm a buyer for your business, I want to know that the top talent's not walking out the door as soon as the check clears.
Our buyers gave options to who we identified as important people to remain in place. It was 6 people.
Options, by the way, just to clarify, and correct me if I'm wrong, is some of the key employees, I know Rich, I think they did this for you guys, is they'll take them and say, okay, you have the valuation at the time of closing is the base value, and now you're going to own a piece of the growth of the company from the closing going forward. So it does 2 things. It secures the employees, but it also motivates the employees to help build the company.
That's what I did with my management team. I took my management team and I gave them all a piece going forward. So I thought it was a good idea.
Yeah.
I wanted to incentivize them, but the buyers came up with that idea, and I thought it was a good one.
Yep.
Yeah, and we've also done signing bonuses for signing on to their new employment agreements, as well as retention bonuses where, when they've been with the new employer for a period of time, they receive a retention bonus. I mean, there's a lot of creative ways you can do it.
Although a stock sale's hard, it eliminates a lot of that stuff because they didn't have to sign employment agreements because it was still City Fire Equipment Company that they worked for.
Yeah.
Questions?
Peter, your regular Phil Donahue.
How you guys doing? In terms of metrics for starting a business valuation, where do you start? In terms of, I guess, coming up with an unofficial official number, and in terms of gross sales or.
Well, when you value a company, you have to look at a lot of aspects of it. And so typically, of course, very, very important is to really focus on earnings. Gross sales typically is cocktail party conversation because, you can have a company doing $25 million in gross sales and the owners are basically pulling salaries out of the business, and you can have a company doing $12 million in gross sales and bringing 25% to the bottom line. So it's not like the bigger company gross sales-wise is going to win out, because that's not the case. Profitability is key. So, as a starting point, we'll typically look at the trend of the business, with 5 years of financial information, just not necessarily to look at what the company did 5 years ago and include it, but see the trend of the company, any anomalies. We'll also then go through a very thorough recasting process to really make sure we capture all the add backs, the one-time expenses, unusual legal fees. If there was some kind of facility maintenance or fees that were done that were unusual in sprucing up a facility or that aren't going to recur every year. We'll look at all the various perks, the fringe benefits that run through the company, from the automobiles to the insurances, to the profit sharing plans, interest depreciation. We'll look at shareholder comp, because shareholder comp, especially with bonuses, may need to be normalized. You may have to normalize rent if you own the property. So these are the things to really make sure you interpret the numbers right. We'll also look at the balance sheet to see what assets and liabilities there are, although that plays much less of a role in the value than you would think. And then we look at, very importantly, the qualitative factors of a company. Qualitative factors meaning the non-financial factors, things that you don't see in the financials that are very important to consider, such as the stickiness of the business, level of repeat clientele, the diversification in certain areas. Once we have that information, what we'll do is we'll typically consider up to 6 different valuation methodologies, and including, we have a number of different databases that have actual privately held company transactions and what they've actually sold for relative to revenue and earnings, and we can identify companies by sector and see what they've actually transacted for and then apply it to the client company. There are income methods, but even though those methodologies get averaged together, each method is very, very clearly included in the valuation, so you know not only what the value is, but why it's valued at that.
Okay. And so you're typically building out projections, like how long beyond?
Well, projections, certainly we do go forward-looking. Depends on the situation. For earlier stage companies, it's more appropriate to go forward-looking. For more later stage companies, generally we're looking at again the most current periods, as well as we'll forecast out the period to come. There are some methods that also, such as discounted cash flow methods, that do rely on projections. But generally speaking, for a more mature company, the value of the company is really more a function of where the company's at now, where it's going in that immediate period. Because anyone could build projections 5 years out.
Right. Okay, thank you.
Let me add to that. Part of our motivation for going to market was we knew the value would be better if we were on an upward gradient in growth, which we were on a nice one. So I was happy to report 5 years of report so that you could say, well, you're buying this growth and it's going to continue. And for us, because we don't have a lot of assets outside of trucks, it was all income statement or P&L, and we restated it, so we took out all the family stuff, the things that people spend that really aren't business expenses and wouldn't be expenses once the business is sold. And then we argued over which one of those items were legit and which weren't.
I would just add that. I'll come back to that. Just come back to it in a minute. I want to.
Yeah. Hey guys. You talked a lot about the due diligence of the seller. I am just curious what your advice, Bill, perhaps it's be appropriate for you, what due diligence you would ask your client to do on the buyer, preparedness to close, funds to close, things of that nature.
Yeah, we generally will certainly involve their accounting firm very heavily, like right from the get-go. That's also why I always tell everyone, your entire professional team of advisors should be working with you just when you're starting to contemplate it. But once you get to the point, it makes it easy when you have companies that are publicly traded, but when you have private companies, you're relying on the data that they're giving you in terms of their value and their numbers. So having the accounting firm get involved and kind of rip through that and be able to ask questions, I think is very important. One of the interesting things is with the kind of proliferation of private equity deals, in most cases, they won't give you financial information. I mean, I've had a number of deals where they'll basically say, this is how much we have in our fund. These are the deals that we've done. Here's a list of people to talk to. And they'll give you, a one-page high-level summary of what they have, or they'll give you the EBITDA of the platform that they're building, but you don't get a lot of information. So on some level, those transactions can be a little scary, which is why you try to look at groups that have a track record and that are kind of known in the business community and have done a lot of significant transactions to get a higher comfort level.
Bill, I was going to just say
Yeah.
that higher interest rates, have caused, on one level, the market to slow down a little bit, because when money is free, people do a lot of stupid things when the cost of capital is zero. But on the other side of the coin, we're seeing a lot of acceleration in the sense there's a war for talent out there. There's a war for employees. There's not enough employees in virtually every business. And so you're seeing a lot of strategic companies coming in to the marketplace that will pay a premium and keep values very high. You're also seeing a lot of merger acquisitions going involved. As a standalone business, the business may be worth X, but the very nature of an M&A is you're taking two streams of revenue and moving it through one stream of fixed overhead to make that business much more profitable in the M&A than it is as a standalone. And then the last element that I've only really seen come in the last, where I've personally been affected by it the last 6 or 8 months, is artificial intelligence is coming and helping velocitize deals and bringing more players to the table and helping, firms like Steve's. And I think you're going to see that trend continue, and it's going to play out in this space, quite substantially.
Alan, just to add on to that too, we also recommend, a lot of times our clients will do what amounts really to almost like a background check on the company and the principals. There are companies out there, third-party companies, that specialize in doing those checks. We'll also look at searches for the dockets for lawsuits and things of that nature to just see outside of just the financials, what's as a matter of record that you can dig up that would give you insight. Is this a litigious company? One that was interesting, where a client of mine decided to go in a different direction, was, interestingly enough, the company had sued multiple principals of acquisitions they had done. Mm-hmm. Maybe not somebody that you're going to be excited to do a deal with. Yep. So those searches can be helpful also.
So what role, if any, putting the financials aside for a second, does culture play in terms of making a company attractive for purchase? There's certainly costs associated with high turnover, weak leadership, liability concerns. So where does that fall in?
For us, the candidate we picked, the overriding value was their culture was very similar to ours, which was important to us. We have 100 employees, and we're committed to them, and we didn't want them to get hurt. And so far, nobody's lost a job in our company. They may be in a new role because of the changes, but they've been offered opportunity to learn something else. But the attitude is similar, and it would really help. I can't imagine, in retrospect, I can't imagine having gone with the other three that we turned down, because I know this wouldn't have happened.
So what about a company that just has high turnover, right? Weak relationships, cliques, gossip. Do you encourage companies to invest in a consultant or training to address those issues? Because they do affect the financials, they do affect the bottom line.
Yeah, that goes to the preparation issue. I always start with trying to troubleshoot, what are things out there that during this diligence process, and they ask you, on that 18-page list, there's a whole section on employment and employment compliance, and you have to provide, your census and your rosters, and not just the current one, but for prior years, so they can actually analyze that turnover. So the buyers are, especially the sophisticated buyers on larger deals, they're going to dig into that, and it is going to matter. And that's why, when I look at what I call troubleshooting, it's, it's across the board. It's there. It's, have any, even if there's a lawsuit not pending, has there been one threatened? Are there any particular employees that are problematic? Is there anyone that's such a key person that you have to make sure that they're locked up and they're going to be part of the deal? I mean, you can go, leadership issues. So, what I found is that especially sophisticated buyers, they are methodical and they know exactly what they're doing, and it's a long process that by the end of it, I always joke with my clients that they're going to know your genetic code by the time the transaction gets to the closing. And I also often use the phrase to avoid deal fatigue, because what'll happen is if you're not used to the process can be daunting. So in all these issues, like the ones you're raising, they're it's not just legal and accounting and other things. There's so many things that tie into it. Somebody mentioned earlier real estate. Whether the company is leasing or owning real estate, there's a whole analysis where they do a deep dive into that aspect of things. So, it all goes back to troubleshooting and preparation. I'll just throw one more kind of like fun story about doing searches. I tell clients a lot of times, especially in closely held companies, to do a search on themselves before someone else does a search on you and what's out there. And I'm not just talking about judgments and liens and things like that, which are kind of the traditional things. So I had a scenario where we had recommended that we do some deep searches, and this particular client really thought it was kind of a silly exercise, so they didn't do it. So the transaction's proceeding, and the buyer, of course, does the deep dive, and there was no debt, and there was no judgments, there was no pending lawsuits, But what there was on like page 6 of Google, a prior arrest that had happened 7 years prior that the client thought was expunged and didn't mention to the professionals or the buyer, and concealed it. And of course they found it. And the company, by the way, was a thriving, growing company. And throughout that whole 7 years, there had been no problems whatsoever. The buyer didn't do the deal because it was an integrity issue to them. It was the fact that they said, look, the business is a great business, but if this person going forward is going to be a CEO of this company, which is what they wanted, that's something that we would have wanted to have been disclosed, and because it could have been easily explained, but the concealment of it is what ended up actually killing that deal. So anyway.
On your question, when we got to 50 employees, we got our human resource person. That's when it made sense. And part of that was internal marketing to keep the people happy and try to build the camaraderie. That's how we did it. But every business is different. Steve will tell you, some businesses aren't buying your employees. Today, a lot of them are because they're scarce. But for us, the employees were critical to the sale.
One of my pet peeves is that when people talk about employees as an expense, I think there's only two things. There's investments and there's expenses. If you're an expense, you should fire them all. And if they're an investment, you ought to invest in and have development plans for those employees. And so that's why I think everybody in every firm should have a coach. I think every sports team has a coach, every golfer has a coach, every people who play at the top of their field has a coach. I think every business should have a coach, and they should invest in their people.
Thank you.
Hey guys, this is for Paul and for Steve. Paul, for you, when you were approaching your father-in-law to purchase the business, how did you give him an indication that you were going to take care of his baby? I'm sure many of the business owners in this room see their business as a part of themselves. And then for Steve, when you're identifying buyers of a business, how do you know that that buyer is going to uphold the reputation and the good works of the previous owner and of the founders of the company?
You don't. It's about trust. I'm being honest. It's how I get customers. It's about trust. I tell my people, you're not going to sell them anything until they trust you. So build a rapport, build a relationship, and then the opportunities will present themselves. I worked with my father-in-law for almost 20 years at that point. The family was in crisis because there was dissension among the third generation, and it was a critical point. And his dream was for his kids to have this business. And one of the kids was creating a lot of problems. So an opportunity, a window of opportunity comes in business. That's always what I look for, is windows of opportunity, because it's fleeting. That the sibling had aggravated everybody in the family at the same time. So I took advantage of that. I was in Florida with my son, and I came back to have the meeting because I knew if I waited 2 days, wounds would heal. And honestly, that's how we accomplished it. And it wasn't just me, it was the third generation spoke to the second generation, said, give us the problem, we'll deal with the problem. You want to give us all the stock, you gifted it to them. He got a nice employment contract. And then they exited the sibling. That's how it all came about. And it worked out. And my father-in-law's, he's going to be 90 this year. He's still kicking, and his wife is 93. So it's worked out for them. And it certainly has worked out for us, because what he gave us, we built into something. We're I think 5 times larger than we were in 2000 when we executed that.
Now, most of the time, the buyer and the seller are aligned. They both want to grow the business, expand the business, and especially if there's some retained equity. And you have to some degree, make an assumption that the buyer's not going to do something that's going to really hurt what they're buying. And I think they recognize in any closely held business that they're buying a lot more. That they're buying the employees, they're buying the culture, and they don't want to disrupt that culture. But there's really no way to tell the future. You would hope that anyone looking at it, the buyers that are usually the most successful, recognize that they're better off not making major changes right away, and focusing on what the business has been doing, what it does right, perhaps what it does wrong. And then after they get a good understanding of the current landscape, hey, what changes can we make from here? And it does help when you really have a respect and there's a good relationship with the prior seller, because the seller really has the finger on the pulse of the company. And some buyers who just think they know everything, it could be a very big negative. But there is a little bit of a crapshoot there, which is what Paul said.
Hi. So to piggyback on what Mark said earlier, with interest rates heading where they are and where they are right now, are you seeing any slowdown that could affect anyone in the room who may be interested in a sale in the coming months or years, mostly because a lot of these groups are leveraging the deals, or frequently are leveraging the deals?
I don't know. I would ask that to Steve.
Well,
I'm
okay,
seeing
Steve.
both. I'm seeing on one level it's a little bit of a headwind, but I'm seeing all those other opportunities there that I still think it's robust and growing. And I also, my own suspicion, and I don't have a crystal ball, is that I think interest rates will come back down towards the end of the year too.
Yep.
I wouldn't be concerned. I think it's a very robust market. I mean, Steve, what do you think?
No, there's definitely more caution out there. Banks are not, they're looking for more equity in a transaction, where maybe the bank might have at one point given 3 times cash flow or 3 times EBITDA to leverage. Maybe they're giving 2. Maybe deals have to be structured in a different way. But there definitely is a lot more caution out there with the increased amount of equity that's required and the higher interest rates. So it is having an impact.
Yeah, and I'll add on to that. In some industries where there's a lot of consolidation going on and valuations have been particularly high for a while, I'm seeing that there's still a lot of deal activity in those segments, but there's a little bit of a compression on the multiples because of the borrowing costs.
So here's my thing. Richard and Paul, kudos to you. It's from listening to your presentations, you've spent the time, the years, to develop your companies, to get them to do the right things, get systems in place to make them attractive to be able to be sold. And Bill, you said it before, and I believe you're 100% right. They came, Paul's company came to you early in the deal, so you could do the proper planning on it. Now, my question, I guess, goes more to Steve and to Mark. Now, my business is a fractional CFO. I work with a lot of companies on both sides of the transactions, more sell side than buy side. Most of the family companies that I've seen are not like your two companies. They run more by the seat of their pants. Decisions get made on the spur of the moment on a transactional basis. When I've walked into some of these companies, I've gotten them to stop before they go to actually go to the market and to let's rebuild the systems to make them more attractive. But the two of you are more into this thing than me. What's your reaction if you hit a company that's really that messed up, that really needs to spend the time to develop core systems to make them attractive to a potential buyer? Would you have them stop, or would you just go to market?
It depends on, it's a lifestyle decision, and certainly if there's something that can be a relatively quick fix, then perhaps, you would tell them, hey, delay it, fix it, but there are certain fixes that could take years, and then you just have to present it the best you can. And sometimes you can also point out to a buyer that, hey, this isn't the most well-oiled machine. There's definitely room to grow this business and make certain improvements. But yeah, preparation is important, and it is important to really try to especially address dependencies and concentrations. When you have a situation where there's an owner dependency, an employee dependency, where one employee can leave and the company can be really in a very, very difficult position, or a customer dependency, like Rich mentioned that he used to have, where one customer, and anyone who has a customer over 20-25%, you have to really be concerned about that. That's going to be looked into very carefully. Many times the buyer is going to want to have a meeting prior to closing with that customer to get a better understanding of their future with the business. So there are certain things that could take years to fix, and there are certain things that can be quick fixes. Paul had the opportunity to just put it on hold for 3 years, but a lot of people don't have that. So it just might mean the business not being as attractive to someone and having it.
I would also say if it's a family-held business, every family has a dysfunction. It's just the level of dysfunction. And by the third generation, I just say pay market, because a lot of times when that business gets sold, a lot of those people have their lifestyle cut drastically because they were overcompensated for what their role was. But having said that, I think that, as you said, even some very, very successful business, there's a lot of well-run businesses, but there's also a lot of people out there who think they're business owners, or they think they're entrepreneurs, but they've really bought themselves a job, maybe a very, very good paying job. But I think what you want to do, I think what a great fractional CFO would do, is to help people to get paid for what they know, not what they do. I always say, entrepreneurs, I think everybody in this room is a CEO of their own life, and many of you are CEOs of your own company. But I think if you're an entrepreneur, entrepreneurs aren't CEOs. Entrepreneurs hire CEOs, and so I think there's a big differentiation, and there's a lot of work, and that's why firms like yours fill such a valuable role in the marketplace.
One of the decisions I made in 2010, when my bookkeeper retired, was I needed to get a new bookkeeper. And my sister, who was an accountant, went to school with a guy who started a firm such as yours. And I brought him in as a part-time CFO. And I started getting my data every month instead of whenever I got around to doing it. And that became a powerful tool at the end of the month to see how do we do, what do we have to work on. And getting that P&L every month and responding to it is where we started.
I think what I'll do now, and I hope if there are questions afterwards, please, as you're having another drink, if you'll enjoy spending some time with our panelists. But I'd like to turn this over to the panel for closing remarks. If anybody would like to add anything before we conclude.
Well, I just want to say one thing. That it was mentioned many times tonight about preparation to sell your company. And that is really the most important thing I think you could do. If anybody's interested in selling their company, go to school, learn what you need to do, talk to an advisor. He'll give you a whole list of things you need to do and start putting those in place. And to answer one of the questions that somebody else said about depending on, I think if you ask any business owner, what don't you like about your company, they will be able to point out certain things that they don't like and that they would change if they could. And if they believe it's hurting the company, then you should make those changes. I'll give you an example. I had a key salesman who was a real pain in the ass, and I put up with him because he brought in business, but he was nothing but trouble when he worked for me, and he was nothing but trouble after I sold the company. We eventually had to get rid of him. He was just a nutcase. So I would have been better off getting rid of him before I made the transaction, to be honest with you, because you could always replenish sales. If you have a good company and you're doing the right job, you could always get more business. So that's really all I wanted to say, because I really believe strongly that's very, very important for anybody who's interested in selling their company.
Yeah, I want to add to that, Rich, that I think that you think about as a business owner what might keep you up at night, and what risks might keep you up at night, and you can anticipate that the buyer will be 10 times more fearful because you as the owner are used to living with that gun to your head of having that very large customer that if they left can hurt the business. But someone comes in with a lot more caution. So really try to really feel, hey, what are the risks here? What are the concentrations, the dependencies that I can address that will allow that I know are going to be big concerns of a potential buyer when they're really looking at the business.
I would say that I would just end by saying thank everyone for taking time out of their busy schedules to come here. It's hard to get people on a beautiful night to come out. But I would just end by saying this is I've probably been asked 10,000 times some variation of this question. How do I grow my income? How do I grow my business? How do I sell my business? How do I grow my freedom of time? How do I grow my freedom of relationships? It's wrapped around one of those questions. And we've always thought that was the wrong question. The right question was, who do I need to collaborate with to grow my income or sell my business or have my freedom of time or freedom of relationship? It's kind of who, not how. And I think for a business owner, it's can you create some great who's to help free up more time or to help accelerate the growth of your company? So it's always who, not how, because as an entrepreneur, as many of you are, it's pretty lonely. You're by yourself. It's great to get in a room like this of fellow entrepreneurs, but it's always who, not how.
Just a couple of closing thoughts. One is you have to make sure when you're going to sell a business that you are mentally and emotionally prepared for the process. Because it's a traumatic thing. It's like a family member, So that's one thing that just from over the years of doing M&A. The other is, to the extent you're able to, always sell a business on the upslope while the business is doing well and growing and thriving. Don't wait until, that industry thing you're worried about that's lurking down the road or around the corner that hasn't happened yet. Wait till it blows up 5 years later and now the business isn't worth as much money, or when you're on the upslope and you feel like you're mentally and emotionally ready, that's the time to do it. Don't wait until the business is contracting.
All right. Sorry.
I'm sorry.
Go ahead, Paul, please.
I felt compelled. Educate yourself. That's what I did. There's a lot of resources out there, like Bill and Steve. But back 30 years ago, I went to the Family Business Institute at Fairleigh Dickinson, which was very good for me. And what it did for me is learn that what I was going through wasn't unique. Most businesses are family businesses. So I learned a lot there. But there's also a lot out there, information, whether podcasts where you can learn current events, there's books, and there's coaches are very good. But you also want to, and what I do is I pinpointed down to my industry, because everybody's industry has its idiosyncrasies and it has its different value sets. So I looked to see what was of value in our industry to the buyers. And each of you, your industries have that either through your trade groups or the consultants that serve your groups.
Well, I want to thank our panelists, and I encourage all of you, following the presentation to please introduce yourself to everyone on the panel. Feel free to continue to answer your questions. We still have plenty of food for dinner.